Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers. Now, the data is in, and right now, you guys, we are going through an overwhelmingly evident housing market recession. And we have a systematic failure of unaffordability going on right now, not as a result of the skyrocketing interest rates going up and the high rates and the high payments. We have a systematic failure of unaffordability due to the low interest rates. So it's really important that you guys understand we're in this mess because of the low interest rates, the quantitative easing, and all of the money printing. So what we're going to go over today, you guys, is basically a warning from the Federal Reserve that are finally acknowledging, and I would argue they were acknowledging this from the very beginning, or at least, for the last several months, right? And that warning is home prices are set to continue to plunge. And I want you guys to think about that for a second here. They're warning us of a potential 20% decline, additional decline in prices. And here's the interesting thing. Right now, we already have a historical fast as far as national average. We have a historical fast price decline going on right now. So it stands to reason as we continue to go into 2023, even 2024 and on, that home prices are going to continue to decline. Now, obviously, you guys, I'm not a financial advisor, even though my bio is as someone that had made it a year. I made it 1 year, you guys, in this game on YouTube, warning you guys about the housing market. My 1 year anniversary was March 1st. So just wanted to take a minute to say thank you guys for supporting me. Thank you for helping my channel grow. I could have never imagined how many people that we would have helped and how big the channel got. So from the bottom of my heart, you guys, thank you. And if you can, please like this video, subscribe if you haven't, hit notifications, share the video. But regardless, guys, we're going to jump into a Fox News article that breaks down a bit more what the Federal Reserve is saying. And then after that, I'm just going to quickly hop into a Fed economic data chart, and then we're going to wrap the video up. And again, you guys, this is a Fox News article right here. It will be referenced in my description, but the name of this article is U.S. home prices could plunge 20% amid risk of deep housing slide, Fed economist warns. And I can appreciate that, them warning. They continue to warn us, guys. This is nothing new. They have been warning us, but what we're seeing happening right now is we're seeing the market fight the Fed. It's the most shocking thing it's just really shocking to me because we have so many warnings now. We have the inverted yield curve. We have the Federal Reserve saying what's going to happen, and yet still the market's fighting the Fed. Now, I believe, the primary reason the market's fighting the Fed is people still got that COVID savings. They still got money. There's a lot of money on the sidelines, and I kind of, realized that myself with the second round of inflation that we're going through. In other words, you guys, right now, I think it's fair to say we have stagflation. So we have stagflation right now, and quite honestly, the Federal Reserve should probably do more quantitative tightening, higher interest rates. Again, just my opinion. Let's read the article. U.S. home prices could tumble as much as 20% as the highest mortgage rates in 2 decades threaten to trigger a deep global housing slide. So this is more than just the U.S. Okay, so back in 2008, 2009, for the sake of argument, the world kind of helped us take the hit. They helped us get out of that financial collapse per se, right? But right now, the entire world, the entire globe is in an everything bubble. And quite frankly, we can't even help each other out here. We're dying ourselves in our economy and our financial market. And again, you guys, I think what's happening with the inflation is stickiest in the housing market. The housing market accounts for roughly 15 to 19% of our economy. Shelter is roughly 40% of CPI. And, inflation is hardest to control in the housing market. So a lot of things will have to break. A lot of people will have to get hurt before the housing market is properly reset. Unfortunately, now this goes on. The global housing market has become increasingly frothy since 2020 as a result of the pandemic boom. So this happened all over the world. And that's why, again, you guys, I think that we're seeing a historical pricing crash right now because the homes went up in value because of COVID, because of the money printing. It wasn't really an equity growth based on fundamentals. It was based on money printing. Would y'all agree with that? Comment below. Let me know if y'all agree with that. The Dallas Fed economist wrote in an analysis published this week Although house price growth has recently begun to moderate, there are still risks of a more severe decline. And that's the thing I'm trying to warn people about. We're only in the second inning right here, guys. Once we have our confirmed recession, once the fear really hits, and I think that's going to be this summer. I think that's going to happen this summer. And I think the reason that's going to happen this summer is, we're going to have our inventory flood spring and summer. And I don't think the buyer demand is going to be there. And when the buyer demand is not there and people have to sell their house, they're going to freak out. And that's going to start hitting, mainstream media. That's what I believe is going to happen. So again, even though we have historical equity decline right now, it's still the second inning. Please listen to what I'm saying, you guys. It's just not worth the risk. And I understand that people on the sideline like me are frustrated. Better frustrated than locked into your house for 10 years, right? Going under, with financial struggles. Would you guys agree with that? Now, this goes on. The economists Lauren Black and Enrique Martinez Garcia pointed to signs of trouble detected in the US and German housing markets. Okay, so they're saying big threats in the German and the US housing markets that threaten to pose a vulnerability to the global outlook because of the size of the nation's economies and significant cross-border financial spillovers. So that's interesting. So, are there a lot of people investing in German real estate? And we already know a lot of people are investing in the U.S. real estate because, before mid 2022, investing in U.S. real estate was one of the smartest things you could do as an investor. So, now that we're starting to see people kind of get their hands spanked for over investing in the U.S. housing market, it's a little bit refreshing. This goes on. Some of that peril, they said, stems from an affordability crisis. And again, see, I think what's happening here is people are underestimating the level of inflation. People are thinking that they're looking at eggs instead of the housing market, right? They're looking at gas instead of mortgage payments, when the reality is those are pretty heavy expenses. Rent and mortgage, that's what we're really looking at here, right? The prices of rent, the prices of houses. And that it hasn't gone down enough, right? Prices have gone down, but not nearly enough, not yet. Signs of diminished affordability in the US have preceded global deterioration. So, affordability, global deterioration, the entire world is messed up right now. Okay, with inflation. I mean, that's a fact, you guys. The possibility of a domino effect where investors pull out of international housing, okay, again, we haven't really seen this yet. What we've seen is we've seen investors, for the most part, stop buying so much, but we haven't really seen them completely pull out. Although Blackstone, you guys have probably seen the videos by now, but Blackstone, you guys, unbelievable, one of the biggest institutional investors in the housing market, residential housing market, even commercial residential, has defaulted on a loan. All right, so they're in big time trouble. I'm telling you guys, institutional investors will not be able to save us this time. For the U.S. housing market to return in line with its fundamentals, the researchers estimated it would need to experience a 19.5% decline. The problem that I see, y'all, is there's no science in crashing the housing market, right? They're just trying a whole bunch of things. And I believe in order to get to that 20% decline, there's going to be massive problems. There's going to be massive pain. And in certain metro areas, it's going to continue to go down. Like Austin, Boise are already down, and places in California are already down over 20% from peak. Really amazing, you guys. Really, really amazing. Let's keep reading. Higher mortgage rates threaten to make the price correction even more dramatic. Good. Because why is that good? Because it was dramatically raised, right? The equity growth in 2 years, roughly 40%, is breaking all fundamentals. And remember this, on a $500,000 house, if a $500,000 house went up 40%, it only needs to go down roughly 29% to get back to the normal. Do y'all understand? It went up 40%, can go down 29% to get back to the same price. That's using a $500,000 house. While a modest housing correction remains the baseline scenario, because we already have it in most metro areas, the risk of a tighter than expected monetary policy may trigger a more severe price correction in Germany, and the US cannot be ignored. But the thing is, guys, it says tighter than expected, but isn't the Federal Reserve telling us what they're doing? Didn't they say they're not even going to consider lowering rates until deep into 2024? From what I can tell is the Federal Reserve is telling us what they're going to do, and it's the market that makes things so confusing, like the stock market, various other financial markets. It seems to me they're fighting the Fed, especially with the new construction, new home building. It seems to me they're fighting the Fed, and not once did the Fed say that they're going to pivot or U-turn this year, not even one time. So it's just a really bad narrative. The narrative is this time it's different. The narrative is that it's this time it's different. And what we've learned about when people say that is almost every time they're wrong. So if someone says this time is different, usually you can bet, like if it was odds in Vegas, everyone would take this bet. Usually you can bet against them. And again, you guys, it's really shocking to me that the lesson is never learned here. Really, really shocking. It's just a repeating of history. Let's continue. During the COVID-19 pandemic, home prices soared at a pace not seen since the 1970s, with mortgage rates near record lows. Home buyers flush with stimulus cash because this was a COVID housing bubble, not a housing bubble based on principles and fundamentals. It was printed. We printed this bubble, and eager for more space during the pandemic flocked to suburbs like Boise, Austin. Demand was so strong and inventory was so low as a result of lockdowns, right? At the height of the market that some buyers waived home inspections and appraisals or paid hundreds of thousands over asking price. And this is why right here we're seeing the record historical equity crash without unemployment, foreclosure, and hypersupply. Okay, listen to what I'm saying. This right here is why we're having historical equity crash, because so many people went and paid too much for the house, like literally over appraisal value. So what we're seeing, this initial stage and, the second inning is, I believe we're seeing the fat trimmed, right? All of the fat is being trimmed, and that's why it's kind of going down at historical paces. All right, so we're almost done with this article. The frenzy came to a halt when the Federal Reserve embarked on the most aggressive interest rate hike campaign since 1980s. Good. Thank goodness, because that's what we needed. It tried to slow the economy and crush runaway inflation. But again, you guys, obviously inflation reared its head back up. I believe we're going to see a couple reports that are super bad that show high inflation, quite frankly. I think the next couple inflation reports this month, they're not going to be good. I don't think they're going to be good. The interest rate sensitive housing market has borne the brunt of the tighter monetary policy, although mortgage rates have fallen from a peak of 7.0% notched in November, but that's not true. We're back at 7% right now. They have recently reversed the trend and started to march higher amid interest rate hike fears. The average rate on the 30-year fixed mortgage rate climbed to 6.5% this week, according to data from Freddie Mac. Okay, but again, you guys, if we access the rates today, it is going to look much, much worse. And the reality is we need a strong Fed, right? We want the Fed to be strong because we want things to go relatively back to normal. And we can all agree that right now, and I'm just talking about the housing market, I'm not talking about eggs and bacon, okay? Just the housing market, rent, mortgage, it's bad. Y'all, it is not normal. It is bad. I feel so bad for all of the people like low class or at the bottom. Those are the people that are getting hurt the most right now. Those are the people that don't have money saved. Maybe like the upper, lower, and middle class, they still have the COVID money. They're starting to get hurt. But understand, in order for like the middle class and upper class to get hurt, in order for these things to happen, the sad truth about all this is the lower class is going to have to take the biggest hit. And if you think about that, it's sad. It is sad because in order for us to win, and again, we didn't make this housing market like this. I'm just warning you guys to stop, wait a minute, let the dust settle, wait for the deal of your lifetime, right? The greatest deal of your lifetime. But understand also, we have to be careful with the hate because now we have the data on our sides. We don't have to be defensive anymore. We have to be careful with the hate because people have to get hurt in order for us to win. Don't forget that, you guys. Now, we didn't put them in this mess. We didn't make them buy. But still, you have to have a little bit of empathy because it's bad. It's so bad. The people that purchased in the last year are going to be bag holders for 10 years if they can even make it through the financial hardship that we're, just now starting to begin. Think about it, you guys. And here's the thing. It's no wonder why we're having historical market crashes. Look at this Fred economic data chart real quick. Okay, Fred economic data. Here's the run up, you guys. This is the massive run up. Again, people going over asking price. This is why we're going to, we have record decline. I mean, look at this. And let me show you the max. Okay, here's the max. Look at this run up, you guys. Here's the last bubble. Look, right here. That's all. Just this little bit right here, right? And we had a total collapse. So what do you guys, and this is my point, like what are the people that are on the other side of the coin think was going to happen when this broke every fundamental? What did they think was going to happen? Now, normally, we were supposed to have safeguards in place so we didn't get in this situation again. And one of those safeguards was appraisals. The appraisals were supposed to protect us from unrealistic equity growth. But again, that's going to fail if people are still going to decide to overspend. So, the home was appraised for a lower amount and people were just paying above that. And I'm not talking a little bit. I'm talking 20, 30, 40, 50, 60, $70,000 above market value. And what that does, guys, is it creates a comp or a comparable. Comparables or sold properties are what is used to generate an appraisal. So think about that. A lot of manipulation in this housing market as a result of lockdowns, COVID, and money printing. So in conclusion, you guys, the data is on our sides. If you're on the sidelines like me, just stay put. Work on your ability to understand what a great deal is. I'm going to keep preaching this to you guys. One of the ways to do that is get with realtors, interview them, not based on their cheerleading, based on their data, based on their ability and skill to understand and provide you data. You guys should be asking for market analysis for the last 4 years, 2019, 2020, 2021, and 2022. I did a live with you. I showed you that could be done in about 5 minutes. So I need you guys to start going out there and figuring out what a great deal looks like. And again, have a realtor access MLS market analysis for the area you're interested in, get the average price per square foot, median sales price, and square footage, just like I showed you, right? But also, you guys, continue to improve your situation, credit, income, assets, right? Positive mindset, love your family, and help some people along the way. Now, other than that, guys, I really appreciate you following along with me on my journey. And if you're out there investing in real estate, I wish you luck and I hope you win.